Hello, everyone. Hello, hello, hello. So, it's been a crazy week in the market, and I thought I'd come on to talk a little bit about what's going on with GameStop and short selling and these hedge fund companies because I know this is a question on everyone's mind this week, and we're getting a crash course in short selling. So, before we get started, I wanted to say that when we talk about investing, we normally talk about buying low and selling high, right? You want to buy a stock at a price that you hope that it would go higher than the price that you bought it at. And, if the company is doing well, which, we all want the company to do well, you want the performance to improve. And with that, the stock price of the company will be higher and you will make a profit. And generally, that's what we want in investing, right? Especially when you're doing long-term investment, you're buying and you're hoping the economy does well, company does well, and you'll profit with that company. And this is how you'll make your return. However, there's another way to make money in the stock market, and it's through even when prices are not going up, and that's through short selling. Short selling is a really interesting, I guess, way to make money because you're basically profiting off a company not doing well. So you want the price of the stock to go down because you will make money off of that lowering of the price. And this is how short selling work basically. So let's say the price of a stock is here, but you think it's going to go down. So what you do is you borrow it at this, you borrow it right now, and then you sell it at a price that's here. And then when hopefully the price goes down, then you will buy it at a lower price and you keep the difference. And to illustrate in a way that might make more sense for you, let me give you the example of gas, right? Let's say you think the price of gas is going to go down in the next couple of days, weeks, or months, or whatever, and you want a profit of the price going down. So you're like, all right, I need to borrow a gallon of gas from someone, right? So you borrow it from someone and it's worth now $10. So after you borrow it from that person, then you sell it, right? You go out and you sell it for $10. But then eventually you have to return it, right? Because you borrowed it from your friend and you need to return it. So you wait for the price to go down because that's what you were anticipating. And if you're lucky, the price does go down. So let's say it goes down to $5. So you're like, sweet, it's down at $5. Now let me buy the gallon of gas at $5 and then I'm going to return the gallon to my friend. So you return it to your friend and then you keep the profit of $5. So you sold high and you're buying low and you keep the difference. And that's how short selling work. So you're hoping that at the price that you sold it at, and you had to borrow it, right, to sell it because you can't sell something you don't have. So at the price that you borrowed it at, you sold it at that price. And when the price goes lower, then you buy it and then you keep the difference. The problem with short selling is one, it's psychologically weird, right? It's like you're profiting of someone not doing well. Like it's you're betting against a company doing well. You want the company's stock price to go lower so that you could make money off of it. So it's really weird, and most people don't short sell because of that. And the other part of it is short selling. With short selling, your loss potential is unlimited. If you buy a stock, you like say you put $1,000, you buy a stock, and if the price goes down, then you lose money, but you can only lose what you put in. But when it comes to short selling, you could lose more money than you put in because there's no limit into and on how high the stock price could go if it goes against you. You may hope that the price will go down, but that doesn't necessarily mean it's going to happen. So if the price doesn't decrease like you were hoping and it actually increases, then you have a crazy loss potential. And when you're short selling, you also kind of have to buy it on margin. You need to have margin in place to be able to short sell. So if the price goes against you, then they're going to start requiring more margin, and that is going to cause you to have a great loss. And this is basically what we saw happen in the case of GameStop, right? So The story started with these big hedge fund companies deciding that GameStop wasn't going to do well, and it has not been doing well, to be honest. Like, it hasn't made a profit in like 2 years. It's just not a company that's doing well these days, mainly because the industry of gaming is changing. People are going online to do their gaming, to buy games, as opposed to needing an actual, physical game. So it hasn't been doing well, and these hedge fund companies decided that, since this company isn't going to do anything, let's bet against it. Let's short sell, because we think the prices are going to go down, since it's not, doing really well in this industry, in this environment right now. So they did that, and I think I guess the interesting thing about this move is that they bought more share, or they sold more shares than they're actually available. So they really wanted this company to go bankrupt, and they wanted to profit of this company losing money. And if they're short selling, that would cause the price to go down. But they weren't anticipating this big group on Reddit. What is the guy's name? I think Wall Street Bets is the group on Reddit that found out about this big trade that these hedge funds made on GameStop, and they decided as a group. I think they have like 2 million people following this person or this group and Reddit, and they decided that they did not want the man to win. Right, these big institutional investors that just can move the market with these major trades. They decided this wasn't fair, that they would bet on this company losing money. So then they were gonna buy the shares and make sure that the stock price went up. And that is exactly what happened. So if you're buying shares of a stock, then that means it's in high demand, and prices are naturally going to go up. And the price went up astronomically. It went up thousands of percent. So when the price went up, then the hedge fund companies got basically squeezed out of their position, and that's what they call it, the short squeeze. Basically, the price went up, and they had to panic and buy back so that they could limit their losses. But it happened so fast that they lost so much money, like billions and billions of dollars, and they're at the brink of bankruptcy because of that, right? And so this is why short selling is so dangerous, because your loss potential is basically unlimited. But the cool thing, if there is, about this, is that this is kind of like a fight between the man, Wall Street, these big institutional investors, and regular investors like you and me. Like, you see the power of the collaboration of regular investors, like these 2 million, I don't know how many people, just decided that, what, we're not gonna take this from you, the man. We're going to get together and show you what we can do. And they were able to cause these big hedge funds to lose billions of dollars. And it's just, I don't know, it's the rebel in me and the revolutionary in me is just like, yes, like, it is possible for us as normal people to, like, band together and actually make major moves and make major changes. So I think that's one lesson that you could see in this, is that the power in the common people, if we're able to rally behind a cause and get together and make moves together. So that was the first lesson. But then there was like this twist in the story when Robinhood decided, and some other brokerage companies decided, that they were going to limit the trade of GameStop, and some other, I think AMC was another company that was involved in this type of trade issue, and so they limit the potential for investors to trade these stocks, and that caused the uproar, because wait a second, and institutional investors could do whatever they want in the market, right? Like, they could like bet against a company like GameStop. They could make big trades that could cause like companies to to lose or to gain, whatever. They could make big moves in the market, and they're allowed basically to do whatever they want. But now that now that regular investors are banding together and are using the same rules or the same, opportunities that these people do, all of a sudden, like they're trying to limit them from, from trading. And of course, they're saying it's because, oh, they want to protect the consumers, which, is valid on some level, right? Because with Robinhood, especially, and those types of, brokerage companies that made trading accessible to basically everyone, there has been some risk involved in that, right? A lot of people just got into trading. They're like, yeah, I can do it now. I don't need much money to trade, and it's free to trade on Robinhood. And they're not doing their research and they're not getting educated. So they're trading and, losing a lot of money, maybe money that they couldn't afford to lose. And it's causing a lot of stress. I mean, we've heard horror stories of people losing their life savings or more money than they could afford trading on Robinhood because it's so easy to do. And then that has caused, like major emotional distress. And, like there have been suicides when people have sold, I mean, like just lost everything. But of course, that happens with any brokerage. Like, even if you're trading with, like Morgan Stanley or some big firms, like, people, because of the way that money is, it's emotional, it's something that you work hard for, you need. So if, you lose money and you weren't prepared for that, then it could cause you a lot of distress. But so the problem with this whole Robinhood suspending people from trading is that they're saying that it's not fair, that they're, locking out the regular investors from making trades because of what happened. You know, Institutional investors don't have these restrictions. And so it's very interesting. And I don't know if you're trading Gamestop, AMC. I think the other two companies that are, people are talking about is BlackBerry and Nokia. But this is almost like it's a war. It's a war between the regular folks and Wall Street. And all of this increase in price and this fluctuation, it's all manipulation. It's all artificial. Although GameStop is worth, I don't know, what is it now, like around 200 and change dollars. Like nothing has happened in the company. Like it's still the same company that it was, before all of this craziness. So the stock price isn't worth hundreds of dollars, and eventually it's going to go back to normal. I don't think it's a good idea to get involved in this mess and this war, especially because we don't know what's going to happen, right? I mean, we know for sure eventually the price is gonna, normalize, but what is going to happen in between, and it's, like when do you want to get in, when do you want to get out, and you don't know what's going to happen, like within that period. So I'm steering clear because I just don't want to mess with this. And I don't know. I wouldn't recommend getting in there, but of course, like you're welcome to make your decisions. Of course, whenever you're making investment decisions, do your research, look into your own personal financial situation and see, if you're willing to take the risk, if it's worth it to you, and really do your research because, you have to listen to, like to your gut and to the numbers and to your feelings and to, based on what's going on here. So yeah, this is it. This is what's happening. Let me know if you're, if you made some money, lost money, or what your thoughts are on this saga. All right, guys, take care. I will talk to you soon. Bye bye.